Today, he has his own investment fund called ROE Investment Management. And yeah, we're very happy to have him here. It is an honor to hear him speak, and an honor for me to introduce someone that's such a great mentor and that I'm happy to call family. So, welcome him.
Thank you very much, Emilio. Well, first of all, I love BC. I literally, generally, am a BC lover, so I'm so happy to be here. Imagine, 36 years ago, I was here sitting where you are. I have a challenge. I have so much I want to share with you, so much, but I only have 1 hour. So I know that you guys love TikTok, Instagram, Facebook, Snapchat. So you have a small attention span, so it's great, because all my slides are going to go boom, 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 boom. Is that right? I really thank the Latin American Business Club, Emilio, for inviting me here. Fede, thank you very much for everything you guys have done for this presentation. I'm very excited. The agenda for today is basically who is me, JLG. Most people call me JLG or JL because some people in the US can't pronounce Jose Luis. And then a couple of reflections of ideas and things that helped me. Hopefully one of those ideas help you in your future. A little bit about how to invest successfully in the stock market. I've been investing in the stock market for about 36 years. And a little bit of stoicism. I know Angel talked about philosophy. I'm a big believer of that. One thing I told Emilio is that I have so much to tell you that I'm willing to do a Zoom video call to really go deep into both how to invest successfully in the stock market and stoicism in the future. Next 2, 3, 4, 5 weeks, very happy to do that. But for now, I'm going to go a little bit quick, okay? Is that all right? All right. A little bit on my personal side first. Yes, as Emilio said, I actually went to school in Mexico City, elementary and junior high school. I went to Brookline High School, here in Brookline. Imagine, where Michael Dukakis, Conan O'Brien, Robert Kraft from the past graduated as well. I graduated in 1993, as Emilio said, and then I went to business school in 98 at HBS. On the professional side, and this will be very quick, I actually had internships at Lotus Development Corporation in Massachusetts, General Electric in San Jose, California, Kidd & Peabody, New York, Morgan Stanley, financial analyst, TPG, private equity, as a principal, buying companies in Latin America, CEO of Telefonica B2B with my great friend, Paquito Uribe, the father of Emilio. And then my big part of the career is I was 21 years at MFS Investment Management. It's based out of Boston. I co-sole managed about $16 billion. And then I retired. When I retired, I was giving classes of investing and stoicism at Harvard and various universities in Mexico. And some people that know me well said, can you manage our wealth? And then I started a fund. It's called ROE Investment Management, and I launched that in January 2025. I've been a board member of Propasa, which is a paper company, Chocolates La Corona, and Milano, which is a retailer. Something that I will talk a lot about, and Leonardo did as well, is family. I think family is great. I think my family is the core of what I do, why I exist. My wife, Lila, my daughter, Michelle, 26, my other daughter, Joanna, now 24, Christian, who's right here, my son, who I love so dearly. And this is the boyfriend of Joanna. And I put him here because he's basically family. She's been going out with him for about 7 years. I also love my mother, my brother, his wife. My sister had leukemia when she was young, and she had 2 strokes, so she is handicapped. And then my 2 beloved nephews. Family to me is very important. So just for you to get to know me a little bit. What are my hobbies? I love golf. And I like to have fun. Here we are at the TPG Stadium in Phoenix, where they play the waste management. I think you recognize it. I love skiing. It's kind of my passion. I love Texas Hold'em. Anybody plays poker here? Oh, well, we can do some poker later on. NFL, I'm a Pats paddle tennis. I love friends. One of my best friends here, Arturo, is here. We've known each other for, 40 years from high school. So I love friends, and thank you much for coming. I love investing, and I love stoicism. That's a little bit about me. I love giving. I really do. I like to be kind, and I really believe that there's no better feeling than making a positive difference. I think, being in a private jet or a yacht or having all this money doesn't really fulfill you. It really doesn't. But giving and making somebody happy really, really fills your soul. This is my house in the mountains in a golf course community. Every year we try to invite about 170 people. They are caddies in golf, caddies, and their families. And we really celebrate them. We make sure that them and their kids have an incredible time. And we just want to make sure that they are as happy as they can be, saying thank you. At ROE, we donate 50% of our performance fee to the 5 causes we care about as a family. That includes people that are handicapped, elderly, rural women, young children that are underprivileged, and mental and nutritional health. Couple of things about me. I always talk about EPA, 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 Esperanza, Paz, Amor y Alegría. I tell that to my kids, to all my friends, EPA. In English is hope, hope, for a better tomorrow, hope so everything is good, being very optimistic, peace, having peace with yourself, providing peace to others, love, and happiness, being fun, having fun, being happy every day. I like to listen to learn. And I'm telling all of these things just in case it's helpful for you, right? Listen to learn, because a lot of times we just are talking, but if you're talking, you're not learning. But if you're listening, really listening, you're really learning. Curiosity, I know Angel mentioned that, and also Leonardo mentioned that a little bit. Curiosity, I think it's so key. Somebody wrote about Leonardo da Vinci. You guys know Leonardo da Vinci? A book about him, and they really studied him. Somebody was obsessed with him, and he said the most important characteristic of his success was his curiosity as the #1 characteristic. There were 11 characteristics in the book. Be an independent thinker. Hear panels, listen to people, read books, but always have your independent thought, your insight, what you think, not just copy what other people say or repeat what other people say. I'm a Catholic. I am guided by the Virgin of Guadalupe and by God, by Jesus. Every day, I'm so thankful that I have an incredible family. I'm so thankful that I have incredible friends. I'm so thankful for my wife, for my kids, for my mother. This part is so important to me. So I always think the spirituality and having something that's a lot bigger than you just gives you so much strength. I really believe in this. I believe that you have to wake up every day happy with a lot of energy, positive energy. Okay? That's so important. We talked about passion, we talked about a lot of things today. I really believe this. Wake up happy. It's not always easy, and I try to do it as much as I can. I'm not saying that it happens every day. But if you find it hard, just change your mindset. Change how you think. Because that way, if you focus on the negative things about the day, if you're scared about your exam, if you're scared about that, it's hard to have positive energy. If you just say, oh my God, I'm in Boston College. Wow. I have incredible friends. Wow. If you focus on the positives, then you wake up differently, right? Have a positive mindset. Change your mindset so you wake up happy every day. My goal today, I've talked about me from my personal perspective. I really want to give you things that you can take away and, have a positive, valuable session. Because sometimes you're sitting there and you're like, oh, another session. What the hell is this guy going to talk about? I don't want you to feel that way. I put a lot of work on this session so you guys come out with incredible ideas that can be helpful to you, right? So that's my goal for today. It's been about 33 years since I graduated from here, and this is all about before we start talking about stocks. Don't worry, we will be talking about it. We'll be talking about stocks. Couple of things. Be influenced by something. Angel said, Leonardo said too, we are always influenced by something, right? You're so right. I was influenced when I was 16, 18 years old by a movie called Wall Street. Have you seen it? Yeah, the first one. The one with Charlie Sheen and Michael Douglas. Have you seen that movie? If you're not, please go see it. It was 1987. Literally saw it when it came out. And it was like, what do you mean you can buy a stock and be part of a company by owning 0.0001%? Wow! Incredible. I couldn't believe it. I know you guys say, JL, that's stupid, that's so simple, but I just didn't think that could happen, right? You can own a little piece of Nike, of Nvidia, of Coca-Cola, right? Just by going up and up in account fidelity and owning it. Well, when I watched this movie, my mind just went, wow! So I started to read everything I could about investing, and I invested my first stock when I was, I think, 17, 18. I read a book by Stephen R. Covey called 7 Habits of Highly Effective People. And the things that I read, I still use today, right? Be proactive every day. Never blame others, right? Don't be the victim. Think win-win. In the panel today, Leonardo, everybody's talking about win-win. Angel talked a lot about win-win, right? Well, that comes here in 1989. And then I read Unlimited Power by Anthony Robbins. And I really like the concept of I can. I know he calls it can it? It's I can. I can do anything. I've always thought that there's no obstacles in my life. It's just a matter of hard work. It's just a matter of perseverance. It's just a matter of putting your mind into it, whatever you want to do. And he really made me think. He talked a lot about health, a lot about body posture, and a lot about excellence. The same thing as Warren Buffett talked about now. I really think that if you follow those things, it is crazily positive. In Brookline High School, I only got one award in 4 years. And to be honest, when my mother came to that award ceremony, and I did not know how to speak English that well, but it was about perseverance, the diploma. So we had to go back, once we got the award, home, and we looked it up in the dictionary, what the word perseverance meant. It's true. And so this is really me. It's never give up. Never give up. You're just studying for an exam. You're interviewing for so many jobs, and you get your job at Goldman Sachs. Yeah. How did I know about that? Right? How hard? How many times you have to go and interview at places, right? And fail. That's okay. Just never give up. Just keep on going. I failed so many times in so many things. The key is just never give up. Yeah. I believe that professionals only produce two things: either results or excuses. That's it. That's it. That's the only thing you're going to produce ever as a professional. Either results or excuses. That's it. Okay? Be that person that only produce results and not excuses. Winners don't make excuses. My name of the fund, it's called ROE Investment Management, and it's not return on equity, it's results over excuses. I believe so much in this concept that I put it in their name, so I'm really going out there because I better produce results and not excuses, right? I really believe in this concept. I try to be proud of all I do, of all I say, and of all I think. Always really truly do your best. It's so difficult. It's so easy to go watch that series, to sleep, to go to the couch, to do something else instead of doing your very best. Don't do that. Be different. Be better. I really believe in this. So create. I think Leonardo said it and Angel said it as build. Build a relationship with someone, build an experience, build value, build a memory, build a business, build a teaching, build learnings. If you are not growing, you are dying. That's what Anthony Robbins says, which I think is very true. Select growth over comfort. Growth over comfort. Yeah? I'm going to challenge you today for something. I really challenge you from now on, from today, to meet somebody new every month that you would have never met if you didn't get into that uncomfortable feeling. Do that. This is going to be transformational for you. Do this, okay? Because you have friends. friends right here, and it's so easy, right, for you to be friends with her, I'm sure, right? You also got Goldman? All right. This is the comfort zone, right? Be with your friends. I challenge you, I really challenge you, that starting today, whenever you're at O'Neill Library, whenever you're at Babs, whenever you are anywhere, go up to someone you don't know and say, hi, what's your name? You remind me from Guadalajara? Aldo. Hi, I'm Aldo. How are you? What's your name? Oh, I'm Nick. Where are you from? Oh, I'm from Cincinnati. Oh, I'm from Guadalajara. What do you like? Oh, I love tennis. Oh, I like tennis too. What do you want to do? Make a new relationship. A new random relationship. I believe so much on randomness, okay? Because otherwise you just keep being on your own lane. That is a big mistake. Because you don't get exposed to a lot of other things. Today, randomly, I met Leonardo, which I'm sure we're going to make friends. We're going to play golf. What's your handicap? 17. 17? All right, we might not play that golf that much golf, but I'm just kidding. Random, right? What here, random, we talked. Maria, I think she's going to do a beautiful job in a couple of minutes, right, from New York. Awesome, we're probably going to be talking about real estate later and things like that. Randomness, right? But that wouldn't have happened if I didn't stay here and talk to her, right? Well, who's willing to do this? Who's really willing to do this? Very few? Yeah? Seriously? Will you really do it? I bet you, if you do that, you're going to create new networks and you're going to do businesses with those people that you'll meet randomly in the next 5 to 10 years. I bet you anything. But do it. Get into that comfortable feeling. Take risks. When I was at HBS, I made incredible friends. One of them is Paquito Uribe, the father of Emilio, and many others. I have an incredible network, but I only learned one thing. I don't remember much about my classes at HBS, but I remember this, and I use it every time. How do you value anything? Please, give me an answer. How do you value anything? Anybody? How do you value anything? How do you value your wife? How do you value a colleague? How do you value your car? How do you value a house? How do you value your bus? How do you value?
By how much you get from it.
How much you get from it? Anybody else? How do you value anything? How much will be produces? Very good answers. Anybody else? Yeah.
Like what it makes you feel.
How it makes you feel? Well, listen to this. I was HBS, right? A strategic class. And the teacher was doing exactly what I'm doing here. I don't know anything, and we have all these answers, right? We have 90 people in the class, case method and all that. And he's like, no, yeah, good answer, no, yeah, good answer, no. Literally for about 10 minutes. And you know what the answer was? Disappear it from the universe and see how you feel. And I remember that, and I've used that so much in my life, so much, okay? I've managed many, many people. I've had built teams, etc. I built a team in Australia, in Singapore, Hong Kong, in Brazil, hired a lot of people at MFS. And when I was thinking about their bonuses, I was just thinking, if that person disappeared, how would I feel? Oh no, that person creates so much value, such a good analyst, such a good portfolio manager, etc. Right? Oh, we gotta pay them a lot. Oh, if you disappear this person, actually, it's positive. He's, political, grillo, doesn't have too much, right? Doesn't happen. Actually, it's positive. It's a net positive. You disappear that person from the team. I know it sounds a little bit horrible, but you can do it with anybody, with a relationship. Disappear your friend. Oh my God, my life just goes to hell. It's my best friend. I just feel, make sure you're really focusing on that relationship, right? Disappear my wife, I'm dead. I love her so much, right? She's everything to me. So I make sure I take care of her. I'm always, making sure she's as happy as she can be, right? So this is really powerful. Lastly, a couple of quick concepts. I try to be proactive and prevent, right? Well, most people, I'm sick, now I do exercise. Well, do exercise so you don't get sick, right? I got such bad grades because I didn't study enough. Well, study so you don't have a bad grade. Be proactive, right? Decisions. You make hundreds of small decisions every day. right? A decision to talk to Leonardo or not to talk to Leonardo after his presentation. A decision to go to the bathroom in the middle of the presentation or to stay here. A decision to drink water and have your water bottle all the time. A decision to call your mother and say I love you, or a decision to ignore it and not do that. You make hundreds of decisions every single day, right? Make sure your decisions are as good as they can be. All right. Now, money, right? Everybody here in business? You all want to make a lot of money? I always thought about money as just freedom, okay? I don't have a watch, my shoes, but you probably already looked at them. They're probably worth, I don't know, $29.99. It's about freedom, yeah? If you make a lot of money and you have a lot of wealth, you have freedom, right? To do whatever you want. That's how I've always thought about money, and I just put it out there. If you think about money as, oh, I want to have a private jet, I want an incredible house, I want to have this, I want to have that, you're never going to be happy, because you can always have something else. Always. And somebody else will always have a better anything. All right, I know you guys came for stocks. Let's go through stocks, all right? Let's look. How do you invest successfully? I like to keep things simple, okay? I've been doing this for 36 years, but I hate when people come here and start using really bad acronyms that I can't even understand what they're talking about, etc. Keep things simple. So I'm going to try to do that. What do we want? We want stocks that go up a lot, so you have very good returns, like Apple. We don't want stocks that go down, like Barnes & Noble, because of competition from Amazon, e-commerce, etc., right? We want these kind of stocks. Why? Because, and this is not magic, right? They go up for a really good reason. You know, great products, like Apple with iPhone, iPad, Mac, iTunes, Apple, a TV, and everything else they do. Let's go into that, but basically this is what we want. We want stocks that go up and give you very good returns, correct? All right, how do we do that? My view is that you can do this yourselves. It's very, very scary to me when people say, business people, I'm gonna, just depend on somebody else. Because if somebody else, I have so many friends that lost a lot of money because that somebody else, managed their money. You can do it yourself. And with all respect, and I know you do it differently, Leonardo, but at the end of the day, here, I'm going to teach you that you can invest in stocks successfully and have very, very good returns. And also, it's really good because then you're also not going to know what you own. Basically, you need to buy high-quality companies with a wide moat, right? A strong competitive advantage. And you got to start with companies with great products or great services. I will explain a wide moat in a bit. And the other thing to remember is Warren Buffett's rules. Rule number 1, don't lose money. And his rule number 2 is don't forget rule number 1. So I like the concept of being also conservative, right? Because if you are just too risk-averse, you can lose everything. That's not what we want. We're going to be talking about global stocks, right? Everybody knows Apple, Starbucks, Colgate, Google, companies in Europe like Nestle. Before we start, let me just show you one thing. There's a lot of reasons why there's a lot of volatility in the stock market today, and so I think it's very hard to predict the stock market on a weekly basis or on a monthly basis. Why? Because you have wars, right? Iran war, Ukraine war. You have changes in regulation. You have technology changes. You have market indicators, jobless claims on a weekly basis or bi-weekly basis, the Michigan index. There's a lot of things that create volatility during the week. That's why when people tell me I'm a day trader and things like that, that's fine. I know a lot of day traders that went bankrupt, okay? It's very difficult because there's a lot of variables that cause weekly volatility. So what I really like to do is buy great companies with bright futures at reasonable valuations and then hold them for the long term. Okay? I know you can make money in different ways buying stocks, but that's my style. That's how I do it, and that's how I've done it for about 36 years. Keep it simple, all right? People are, oh, JL, but the companies are so difficult, income statement, balance sheet, cash flow statement, etc. Think of it as your person. You, as a person, have a salary. That's just the revenue of a company. You yourself have expenses. You pay your rent, you pay utilities, you pay for school, your electricity bill. Just like a company has expenses, right? So keep things very simple. When you look at a company, what are their revenue, what are their expenses, etc. Think of it as yourself. What is the key then to get these stocks to go up? Here, the orange line is the Apple stock price, right? And the blue line is the earnings per share. So guess what? How can you get stocks, right, that go up? You need what to go up? Earnings per share, right? That's the key. You want to find companies that have earnings per share go up. I know it sounds very simple, but it's not as simple as you might think. How do you calculate earnings? Earnings is basically revenue minus costs, which is net income. And then net income, you divide it by total shares outstanding, and you get earnings per share. Right? Everybody's seen this before? Everybody's here in business, right? So I know it's simple, I know it's almost stupid simple, but it's literally just like this. You gotta figure out what it will revenue be, so prices times volume, understand costs, and then divide it by shares outstanding, and then the earnings per share trajectory will tell you in the long term, as you see there's volatility, but in the long term, what the stock price will do. Yeah? Everybody's following me so far? Any questions as to this? All right. So, keeping things simple, if you think about this very simple equation, costs, right, are a problem because you can reduce them to a point, right? You can fire people, but to a point, you need somebody. You can reduce your plants to a point, but you need some plants, right? So the key is what? It's revenue. It's revenue, 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 revenue. Really focus on revenue for all the companies that you analyze, right? Because costs are just to a point you can't do. So we're going to talk a little bit about revenue, and revenue growth is key. So you have to have great products or services, like an iPhone is a great product. Companies that have innovation like Google Search, high switching costs like Microsoft, high barriers of entry like NVIDIA, a great management team like Costco. In industry has growth, healthcare because of demographics, baby boomers, etc. Revenue, 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 okay? Other ways to think about revenue. We talked a little bit about innovation. Make sure that there's clear evidence that the company that you're analyzing keeps innovating, keeps adapting. Did you hear about who's the person from Guatemala? The name here? Sebastian. Sebastian said that, right? You need to adapt. I'm adapting to customer needs, need to change, need to innovate, need to improve. He said that a couple of times, right? You need to have companies that have successful innovation. You want companies that will have revenue growth by having great culture, great management team. If you're taking care of your employees, you have happy employees, you have happy customers. If you have happy customers, customers are buying your product. They're creating revenue, yeah? You want a company that invests, that has high capex or depreciation, that they are investing in their company. You want companies that adapt to technology, that they use intelligence, AI, whatever you're using, to make sure that you're selling better. And you want the incentives for top management to be based on quality, on customer happiness. I love it when I'm interviewing management, and I've interviewed over 1,000 companies over the last 36 years. I've interviewed companies in Singapore, in India, in China, in the United States, in Europe. I've invested all over the world. I've been based out of Singapore, I've been based out of London, I've been based out of Tokyo, etc. And incentives are so key, but very few companies give incentives on customer happiness. You know, your KPIs, yeah? You want those KPIs not to be on revenue growth and free cash and all that. How happy is your customer? If your customer is happy, what happens to them? They buy more, right? Yeah? So revenue, revenue, revenue. Moat. Everybody has heard of moat before? Right? Warren Buffett invented it. It's just what is surrounding the castle. So you want somebody, you know, a company that has a wide economic moat, right? One that's a very large economic moat. JL, what are those? There are 8 that I really like to follow, but there are more. But there are 8 that are made. Proprietary information, right? Brand loyalty, like a Nike. Scale, like a Walmart. Intellectual property, like a Disney. You know, imagine how many times you can sell Mickey Mouse. Regional oligopoly, like an airport. Locked up supply, many healthcare companies. Network effect, like a Facebook. Innovation. like a Goldman Sachs actually, very innovative in terms of the products that they continue to come out with, in companies that have proprietary information. You can think of so many of those. As an investor, when I manage money, I really ask three very simple questions. Is the company different? Is the company better? And is that sustainable? Very simple questions, right? They're so powerful, right? Because you need a company that's truly different. Then you need a company that's truly better. And then you want to make sure that that is sustainable. And if you can find that, that's a great company with really good revenue growth. Very simple questions, but there are very few that the answer is yes, yes, yes. And I look for companies that have at least 3 economic modes. Not just 1, not just 2, but at least 3. Okay? I also like companies that have very good return on invested capital, and that the management has very good capital allocation decisions. If you're buying companies at an expensive price and then leveraging yourself a lot, big X, never would buy that stock, right? You destroy the company. You're probably too young to remember this, but HP was a great company, Hewlett-Packard. They bought Compaq, you know it, and she destroyed the company, as you might remember, right? So capital allocation is super important. Return on invested capital is so important because at the end of the day, you want to make sure that the management is obviously investing above their weighted average cost of capital. I'm sure you heard this in your finance classes, what is so important, and so many companies don't do it. Look at the math and they just don't do it. So I think that's another thing. I mean, very easy to do. You can do return on equity, you know, net income divided by book equity, and make sure that it's over 14 or 15%. I look for companies with very strong balance sheets. Just like as an individual, right? If you have a strong balance sheet, low debt, very good salary, and a lot of savings, what happens when you lose your job if you have $1 million in the bank of savings and you lose your job? You can find another job, you know, you can wait, etc. Right? Catastrophic things allow you, if you have a strong balance sheet, to pivot. Same thing with companies. If you find companies with a lot of leverage, X. No need to focus on those guys because there's a lot of risk. Yeah? Okay, so we talked now about a good company, high quality company with good revenue growth. Now let's talk about valuation. Because you need to make sure that you buy a stock at a very good valuation, because if you buy a stock at a very high valuation, even though it's a great company, you can lose all your money, right? How do I think about valuation? All right, guys, very simple question. This is 2026 Honda CR-V. I sell it to you for $1 million. Who buys it? You buy it? Come on. It's beautiful, brand new. It works perfectly well. Why not?
Too much, too expensive.
Too expensive. Why? How do you know that so instinctively? How you're so sure? What's your name?
Alan,
Alan. Why?
because you can get for $1 million something better. You look at the comparables and you see like, similar SUVs in the market that are selling for cheaper, and you're overpaying.
Right. Because you know about cars, because you've bought a car, because your parents bought a car, because you know the market value of a car, right? What if I told you that I sell it to you for $10,000? Fit it?
I'll take it.
Take it. Why?
It's a fair value.
Well, it's a fair value, or it's on the market value. It's cheap, right? Because I checked yesterday, and CVRD, depending on the model, goes between $30,000 and $38,000, right? So you can buy it at $10,000. What can you do the next day? Yeah, you sell it at 30 or 28,000 and make more profit, right? But you're so sure because you understand the value of a car, right? I want you to make sure that you also understand the value of a stock the same way, right? To understand if a stock is cheap or expensive. It's not as easy as a car. You have to do a little bit of math. Here we go. This is, bear with me because this gets a little bit technical, but just for a couple of slides. Can you bear with me? All right. So you can focus on a lot of different metrics. Price to earnings is the most common and is the one that we're going to be focusing on today. It's very simple. It's the price per share of the stock divided by the earnings per share. It's such an easy math, right? There's also one that I like to use a lot, which is enterprise value to revenue, market cap, plus net debt plus minority interest divided by revenue. I like this a lot because it's smoother through a 10, 20, 30-year period. And I really like price to free cash flow. Market cap divided by normalized free cash flow. You can take a picture of this. By the way, I'm going to give you the slides, if you ask for Emilio, for both presentations that I'm going to do today. Whenever you want, you can have them. So don't worry, this is available to you. But price to free cash flow is just market cap divided by normalized free cash flow. Free cash flow is EBITDA minus capex minus change in working capital minus interest expense minus taxes. It's very easy, right? Very powerful multiples. If you have a bank like a Goldman Sachs, like a Citibank, like a Bancolombia, which seems like you're a partner with, it's price to book. Price to earnings doesn't tell you much. Price to book, it's much more useful. Market cap divided by book equity, and I always do a discounted cash flow for every company we buy to understand if it's trading below intrinsic value. All right? And you want to make sure that the multiples, you compare these to competitors. You know, if I'm analyzing Coca-Cola and also, you know, analyzing Pepsi, for example, versus its own history and also in an absolute level. Don't worry, that was the most difficult thing we've done. Now we're going to get to easier things. Example, Lululemon. Everyone knows what Lululemon is? Yeah? You bought Lululemon? Yeah? Well, Lululemon is trading a few days ago at $163. Okay? And the 2026 earnings per share estimate is about $13.15. If you divide this by this, you get a PE of 12.4 times. We need to understand this before we go on. Any questions as to this? Yeah? Sorry, I know it's a little simple, but bear with me. Any questions as to this? PE? Yeah?
How do you argue back if maybe one of your analysts say that you can change the net income by just doing financial engineering? And so many companies maybe move depreciation and amortization, adjust costs. So what would you respond back to that?
Very good question. When you do any of that, you make sure that you use price to free cash flow as well. Because it's a lot more difficult to manipulate free cash flow than price to earnings. Yeah? Because that's what's happening right now. As you know, Michael Burry has been selling a lot, and I put it short because he's saying that the amortization and depreciation of all these companies, including NVIDIA, right, it's too long, right? So it's making the earnings look bigger. But if you do price to free cash flow, you catch that. Good question. All right, so price to earnings is, yeah.
Of the four metrics that you said, what's the order that you like to put them in?
I use price to free cash flow as the number one, exactly because remember your name? Ander. Because what Ander said. So I like to use price to free cash flow as the number one, because it's a lot more difficult to manipulate than price to earnings. But most people use price to earnings, okay? All right, so everybody understands PE. Very simple, right? Price per share divided by earnings per share. All right. So, is a company cheap or expensive? Well, let's take a look at Lululemon, for example. It used to trade around 41 times price to earnings, okay? But we have a lot of new competition, right? You have Alo, Ori, Athleta in North America. So look at it. The stock has gone down, but the PE has come down to 12 times. The average PE for the S&P 500 is around 19 times over the last 20, 30, 40 years. The average for Lululemon is 40 times, so it's come down to 12 times. Lululemon could be cheap. Yes, a lot of competition in North America, but it's growing China a lot. 16% of total revenue is China, and it's growing at 25 to 40%. Okay, maybe you have to analyze it. On enterprise value to revenue, it used to trade at 6 times. Now it's trading at 1.7 times enterprise value to revenue. The historical S&P 500 average on enterprise value to revenue is 2.2 times. It's around here. Could be cheap. You have to analyze it, right? What do you think about revenue for Lululemon? What do you think about return on invested capital? What do you think about its balance sheet? It's net cash. So, balance sheet is okay. All right. Another way to think about stocks in addition to PE, right? So PE, you got. Right? You're taking something with you that's tangible. For any stock that you look at today, NVIDIA, Google, Meta, Colgate, Procter & Gamble, Allianz Laundry, which is very interesting, etc. Nestle. You can now tell me if it's cheap or expensive with a PE graph, and that you're 80% there. If you find companies that are trading way below its revenue, now you have to figure out if it's a high-quality company, right, with a bright future or not. But at least you know it's cheap, right? Blue is cheap. No question about that. Yeah? All right. The next way to think about valuation is annual total shareholder return. Okay? Follow me through this. Right now, the Treasury bill is paying you 3.6% per year. Everybody knows this? Yeah? Treasury bill, United States, I'm talking about in dollars, right? I don't know what the rate is, but in dollars, you can earn 3.6% in a one-year Treasury bill, yeah? Okay. So if you pay to invest in stocks, you want to earn more, less, much more? Aldo? More. Why?
Because you want more.
But because, you always want more, but why? Why? Risk. You're taking more risk, right? With an equity, therefore you want a higher return for the risk you're taking. So, how do you get total shareholder return? Very easy math. You have to have the change in price plus the dividend yield gives you your total shareholder return for a year. Right now I'm just doing it for a year for simplicity purposes. Very simple, right? You gotta figure out what the future share price is, which is just the PE times the earnings per share for the next year, plus the dividend divided by the share price. What is the dividend yield? Well, the dividend yield is, as you know, many companies pay a dividend annually. I know most of them do it quarterly, but if you add the quarters, it's an annual dividend. So let's say, as an example, the company pays $3 of dividend per year. Let's say the share price is at 100. 3 divided by 100 is 0.03. It's 3%. Everybody follow me? Dividend yield, 3 over 100 is 3%. Okay, so let's go through an example. Total shareholder return. This is another way to invest very successfully. You buy a company that the share price today is 100 and it's growing earnings per share by 10%. So in a year, right, the share price is up by 10%, assuming there's no multiple expansion, because the earnings per share growth is 10%. Very easy, right? If a company grows 10% earnings per share per year, and there's no multiple expansion or detraction of the PE, right? That is just mathematically the future price of the share. Yeah? If you add the dividend yield in our example of 3%, the total shareholder return is 10% plus 3% equals 13%. Find a company that has earnings per share growth of 10% with a dividend yield of 3%, you get a TSR of 13%. Everybody got it? Yeah? Back there? Make sense? Yeah? All right. Assuming no multiple expansion. Look at how powerful it is to buy a cheap company. Check this out. Let's say Lululemon. Lululemon today trades at 12.4 times. Everybody remembers that? Yeah, I showed you that a little while ago. Here, 12.4 times is the PE of Lululemon. Okay. So let's assume that it goes up back a little bit because it keeps growing North America because it's fighting better against Alo and against Atlantica, right? And the market feels it can give it a little bit of a higher multiple. Let's just say 15 times PE. Well, look at the math. 12.4 times 13.15 of earnings per share is the share price of today. This is the share price of today, 163. If the PE multiple just goes to 15, 15 times 14.47, which is the earnings per share 1 year from now, it's growing at 10%, right? So it's just 13.15, right, times 1.1, it gives you 14.47, right? It's all 10%. The share price 1 year from now will be $217, which is up 33%. Do you get me? The math is easy, right? 33% is just 217 of the share price 1 year from now divided by 163 minus 1. Lululemon doesn't pay a dividend, that's relevant, so it's just this. You make 33% versus how much does a treasury bill make? 3.6. How attractive is that? So find good companies that have good growth that are trading at a low valuation. Because you make the money both ways. through the growth and through potential multiple expansion. And you can make a lot of money. It's not that difficult. Have you followed me through that math? Yeah? It's like this, literally like this. Been doing this for 36 years. Doesn't get too complicated. Obviously, it's hard to find those companies that will grow in the future because of competition, because of technology, because of AI, because of regulation. It's not easy, but if you find those and you can get multiple expansion because you are patient and you buy them at a low valuation, right? You can make a lot of money. Okay? All right. Now, the summary for this part. Look for high-quality companies with predictable revenue and earnings per share growth. Take a picture of this because this is kind of a big summary if you can, but don't worry, you're gonna have the presentation. Strong balance sheet, good ROIC, buy them at attractive PE, and get a total shareholder return of at least 30%. In my fund, I look for 10 to 16% total shareholder return. So I don't buy a stock until I really feel very confident that I can get 10 to 16% in dollars per year, right? Because I'm not that ambitious. Because I want to make sure that I remember rule number 1, which is, and rule number 2. And you guys are good. All right. This is my cheat sheet. I know it's got a lot of numbers on it. Don't worry, we're not going to go through them. But when you get the presentation from Emmy, make sure you pay a lot of attention to this. This is my framework. It's a 1, 2, 3 type of part. It's not magic. It's nothing. It's just very common sense, right? I think Angel talked a lot about common sense. Investing, it's a lot about common sense. First, you evaluate the quality of the history of the company. You got to start with that. You want to make sure that you buy companies with revenue over 5% per year. I'm not going to go through all the numbers right now, but you know, CapEx below 5% because I like asset-light companies. I want, you know, low debt, so net debt to EBITDA below 3 times. So we want to make sure you evaluate the history of the company to understand if it is a quality company. Step number 2 is you look at valuation. You look at enterprise value to revenue, PE, enterprise value to EBITDA, price to free cash flow, dividend yield over the last 10, 20, 30 years. It's not difficult. That chart that I showed you, it's free. Just Yahoo Finance, Google Finance, Coifin, all these platforms give you all these charts that I showed you for free. Very easy to get those charts. Then, this is the more difficult piece. Evaluate the next 10 years for the company. What does the future look like? What is your best guess? So ask questions like, do they successfully innovate? Do they have a great culture? What's the brand like? Do they adapt to future trends? What is the quality of their service? Do they have ESG initiatives? What is the strategy as to capital allocation? Quality of customer value proposition versus competitors, etc., etc., etc. Don't worry, you're gonna have this sheet if you ask this presentation to me. It's a lot of things, but if you do this, you combine it with the Michael Porter's 5 forces, you have a good risk analysis, you should be able to have a great framework to make a very good investment decision. Okay? I didn't come up with this yesterday, I've been coming out with this for the last 36 years. Finally, it's here. Well, the last 40, 15 years. All right. Emmy told me that you guys wanted to know about what is the stock market like today. What's going on? Well, I think it's very expensive. Check this out. Since the great financial crisis in 2008, 2009, this is the stock market. This is the S&P 500. Look at this. The biggest reason why the stock market has been so good for so long is why? Interest rates. Interest rates went almost to 0 for a long time. So when you have no interest rates, right? You put it in a bond, you put it in a money market, you put it in a CD, you don't make any money, you put it in a stock market, right? So we have an incredible bull market. You also have globalization during this period. You have incredible fiscal deficits and governments increasing their debt. You had a lot of ETFs. You know what an ETF is? An exchange traded fund. It's just an index, okay? A lot of money has gone into these ETFs with no price discovery. Nobody's doing any valuation, just putting it into a QQQ or any of these ETFs. Craziness. You've had very much earnings per share growth through share buybacks with cheap debt during this period. And everybody forgets that the corporate tax rate went down dramatically from 35 to 21%. That's not going to be happening anymore. All right, so this is the past. The key question is, what does the next 10 years look like? Okay. The other thing is valuation. This is price to earnings adjusted for inflation. I'm sure you all heard about the Schiller PE. It's the one I really like to use because it's adjusted for inflation. Today, it's around 40 times. This is since 1870. Okay? Over 100 and some years ago. Look how expensive the market is. Only in the bubble of the 2000 was it more expensive. What about market cap to GDP? This is what Warren Buffett uses a lot. The market cap of the broad Wilshire 5000 over GDP. Look at this, it's 224%. Market cap to GDP. Very expensive. Be careful. It doesn't mean that you cannot buy some companies. You can buy some high quality, for example, SaaS companies like Adobe, like a ServiceNow are very cheap now. Figure one out to see if it has a bright future or not, because all of them are down. SAP is down, all the SaaS companies, right? Software as a service is down. If you can find one with a very bright future, it's trading at 12, 14 times price to free cash flow today. So it doesn't mean that everything's expensive. All right, resources. I'm going to leave this for you, but great books. I love these books. Terry Smith is awesome. As you know, he's kind of the Warren Buffett of UK. Unfortunately, his track record lately has been very bad, but he's got a very good methodology. Warren Buffett. I really like Howard Marks. Howard Marks, I think, is one of the best investors in the world. I really like, and I like Pat Dorsey a lot. Those are really good books to read about. In terms of YouTubes, these are my favorite YouTube channels. In terms of investors, this one and this one. A lot of really good things that you can just learn with YouTube. And I'll leave all of this with you. And in terms of places to go that are very cheap or free, Seeking Alpha, Ticker.com, Coifin, Yahoo Finance, etc. So now I have about 5-6 minutes. I'm going to do Stoicism before Q&A. Is that all right? All right, and then we can do Q&A. Stoicism, Angel talked a lot about philosophy. I'm a very big believer in Stoicism and the tools, because it gives you tools and techniques that you can use today to be better. A better person, a better investor, a better professional. So, at the end of the day, I'm going to just share with you very quickly, and I'm going to do it very quickly because I know I started late, so that's why I'm ending at 2:40 Maria. That's why don't worry, they told me 2:40 is okay. Why Stoicism? What or where does it come from? And 3 tools that you can take and then places to go for more. Again, I would love to do a full Zoom meeting with you on Stoicism, or my investing presentation is like an hour and a half long, and I did it like in 30 minutes. All right? Stoicism is 45 minutes long. I'm going to do it in 5 minutes. So bear with me. Why Stoicism? I really believe that it can be transformational. As Angel said this morning, philosophy can be transformational. I personally needed it because many years ago we had a big family illness. My sister had her first stroke. My oldest daughter had a very big operation. The earthquake in Mexico City, COVID, and we had a couple of deaths of incredibly good friends that really impacted me. So I needed tools to be able to deal with this stuff, right? As Angel said this morning, sometimes it's just too hard. You need tools to be able to live better, right? Sometimes when you feel like anxiety, when you feel like depressed, yeah, I do too. So you need tools to deal with that. And Stoicism, combined with eating well, regular exercise, drinking a lot of water, having very good personal relationships, breathing better should make you for a happier and healthier life. Leonardo had a really good thing about habits. I really believe in that. Because your words and your actions create our habits. These build your character, and that results in your destiny. Okay? Let me repeat that. Your words and your actions create your habits on a daily basis. These build your character, which results in our destiny, our future. So obviously you want to start with great, powerful mind and thoughts. A lot of people use this that are very famous. I really like Denzel Washington. I don't know, have you heard his speeches at graduations? Some of the best are Denzel Washington. They're so inspirational. He uses a lot of stoicism. When Nelson Mandela was in prison, the books that he was reading to get out of incredible, difficult times was Stoics. Stephen R. Covey and Seven Habits of Highly Effective People uses it. And cognitive behavior theory is the foundation of this psychology, Stoicism. Amazing. This is 2,000 years ago. 2,000 years ago. The three philosophers that really matter are Seneca, Epictetus, and Marcus Aurelius. I know Angel talked about Marcus Aurelius' books. You don't need to read books. If you don't want to read books, there's so much in YouTube that's awesome Stoicism. Ryan Holiday, the best. I'm going to show you that in a bit. But since I have about 4 minutes, I'm just going to go through 3 tools that you can use tomorrow to be better. Just 3, very quickly. There's many, many, many more, but I'm just going to use 3. The first one and the most important one, which basically Leonardo and Angel also said it, is focus only on what you can control. Let me go through that. 70 to 90% of the things that happen to you, you cannot control. You cannot control if I just keep on talking today for another 2 hours, right? Even if it says stop and I keep on going, you can't control that, right? You can't control if we just go out right now and it starts to rain, even though the weather said it was not going to rain. You can't control that, right? You can't control if you go right now to your dorm and there's no electricity for 2 days because of power generator, right? You can't control that. You can't control if you feel bad about your stomach because of something you ate this morning that you just had a little bacteria. How can you control that? But you can always control how you react to anything. You can. You can control your thoughts, your words, your actions, your habits, your decisions, and your attitude. I really love what Leonardo put in terms of attitude. You can control your attitude. You can be, I'm tired, I hate my life, I don't want to do this. Or, hey, bring it on. Bring it on, whatever you want. I'll do it, and I'll do it really well. You can control that. As an example is this, well, first I'm going to explain to you how this all works, and then I'll give you the example. So, since a long time ago, millions of years ago, we have something called the amygdala. The amygdala used to be the size of a small rock inside our brains. It's seated in the hippocampus, okay? Why? Because millions of years ago, you had a lion that would come to you, and you had to either kill it or run, fight or flight, right? You heard this. Everybody's heard about the amygdala? Yeah. Okay. All right. Now the amygdala is the size of an almond. So it's very small in your brain, but still there. What you want to do is you want to make sure that every decision you make, you use your prefrontal lobe of the cerebral cortex for anything instead of the amygdala. Why? Because the amygdala continues today to be fight or flight. So when you have a crash, right? Many people say, I'm gonna get out, you fucking mother, right? That could be an instinct and your amygdala talking, right? If you breathe just for 10 seconds, you neutralize the amygdala. I'm serious. It's just scientifically proven. It's 10 seconds. 10 seconds. You neutralize it. And then you allow the prefrontal lobe cortex to tell you what to do. What would you do if you had a crash?
Go crazy.
All right, no, but that's your amygdala. Then, am I okay? Is my wife okay? That's a lot more logical than going and yelling at the guy. No? Many people get killed once you have an accident because they run out to yell at the guy, and what happens? Huh? A car hits them. Because they're not noticing that cars are coming, they come out and a car hits them and kills them. Right? You think, is a car coming before I go talk to the other person, right? That's the prefrontal cortex speaking. The next one is embrace adversity. Yes, embrace it. Embrace adversity. Whenever you have an issue, get happy. Get content. All right? Why? Why? Because it's the only way to improve your creativity and the ability of your mind to deal with adversity. It's been proven that just like when you do exercise and build your biceps, right, repetitions, the only way to generally improve your mind to deal with adversity is to go through adversity. It's the only way. So whenever you have adversity, you have an issue, you have a problem, you have an exam, get happy. Because your mind will get stronger. I know it's a very difficult thing to do, and it's taken me a long time, and even now it's very difficult, right? Because your instinct is like, oh my God, I have this problem, right? Embrace it, get happy, and your mindset is very changed. And lastly, time is our most valuable asset. Okay? Time is the only resource that's non-renewable. The only one. Money comes and goes. Health comes and goes, as long as it's not terminal. Money is irrelevant. Time is the only resource that's not renewable. So make sure that you use your time wisely. I'm not going to go through all of this, but investing, obviously I try to focus a lot on the moat, and if the company is different, better, that's what I spend my time on versus the short-term news, right? Short-term news, emails, a lot of stuff are completely irrelevant. But think about how you use your time. So with that, obviously I want you guys to have I'm doing all of this to make sure that you guys have a happy, healthy, long life, right? You have lower anxiety, you make better decisions, etc. I'm going to just finish, so I'm done, with one video that lasts less than 3 minutes, which shows you something that's incredible. Has anybody heard about The Greatest Showman, the movie? Yeah? The Greatest Showman? Have you really ever seen it? Well, that movie was not supposed to be made. It was not going to be sponsored or funded. It's a great movie. It was really success, right? But what happened was that basically they had, said no, it's a no-go, but a last effort was done here. I'm not going to tell you a little bit, I'm going to tell you just 2 seconds once it's done, but we talked a lot about energy, we talked a lot about passion, we talked a lot about things, okay? Kiala, which you're going to see here, Kiala Settle, was always singing behind when she was reading the music. Look what happens in this video. Look at the transformation, and I'll just tell you what happened at the end. But it's all about energy, it's all about passion, it's all about creating and building. Watch this. Also, look at the words. Transform yourself. Be better. If it wasn't for that, the movie which have not been funded, what you don't see is that the chairman of Fox and the key executives were watching this. And once they saw this, at that moment, they changed their mind, funded it, and it became a great movie because of Kiala Settle. With that, I finished. Thank you. Any quick questions? I know I run a little bit. Maria, sorry. Yeah.
I have 3 questions. I'll be fast. Thank you so much for the diversification because most stocks, larger stocks, are highly correlated. Warren Buffett said we should avoid losing, and so when you have downturns, your whole portfolio goes down because it's correlated. What's your strategy for that? And then, what is your philosophical approach to life? How has that changed throughout your time? And then my final question is, what has been a time where you had high conviction in something and it turned out terribly wrong, or something you learned through the hard way, maybe through a mistake?
Okay. Wow, that's a lot. Big question, but very quickly. Concentration. I really, really believe in concentration. In my fund, we're not going to own more than 8 to 15 stocks. But you're right. I just don't buy stocks in the same industries, in the same sectors, and I buy them at a very low valuation. So even when market goes down, we'll go down just a lot less than the market because of valuation, right? People don't sell what's cheap; they sell what's expensive first. So I really believe in concentration because as Warren Buffett, Charlie Munger, Howard Marks have proven is that if you just own a lot of stuff, you just can't know as much of all of them. But if you own 6, 8, 12 stocks, you can know everything, or pretty much everything about them. So I really believe in concentration. If you think about it, he's very concentrated. All his wealth is in right now one company. Jeff Bezos was super concentrated. He made all his wealth in one company called Amazon. Steve Jobs, 2 companies, 3 companies, 0. Most people are very concentrated that make their wealth. So, focus on few companies that are great, own them when they are at low valuation. In terms of difficult decisions, difficult things, and big mistakes in investing, where I've been wrong, companies with leverage. I made mistakes of those early on, 15, 20 years ago. Companies that had some leverage, that went bankrupt, or that I lost a lot of money on when I was at MFS. So leverage can kill you. Be very careful with companies with leverage or bad capital allocation. And your second question was?
Your
third
question.
I'm sorry? Philosophy in life. Money gives you freedom, not material things. Before, when I was very young, I wanted money for material things. And very quickly I realized, not very quickly, but in some time I realized that that's a very, very big mistake because you're never going to be satisfied. Anything else? All right. Well, like I said, very much willing to do a Zoom with investing or with stoicism if you want. Really appreciate your time. Maria, I'm sorry I went a little bit longer.